Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So you have exactly 4 days from the making of this video to ensure that you are appropriately paid in for Q1 2026 in order to avoid getting dinged with those pesky penalties, interest, and IRS notices that are sure to arrive if you don't handle your estimated tax payments correctly. So let's break down exactly what you need to do by April the 15th to make sure that you are safe. Okay, step number 1 is to open the Number Crunch Nerds Safe Harbor Method Calculator. Step number 2, drop your 2025 AGI from your as-filed 2025 tax return into the calculator. Step number 3, drop your 2025 total tax from your tax return into the calculator. And then step number 4, drop your 2025 overpayment applied into the calculator. Okay, here we go. Step number 1 is to open the Number Crunch Nerds Safe Harbor Estimated Tax Calculator. The current year is 2026 and the prior year is 2025 for purposes of this example. Okay, step number 2, enter the prior year, meaning 2025 AGI. This is an actual per hour tax return. For this example, I'm going to say that amount is $391,562. And where do you get that number on your tax return? The answer is Form 1040, line 11B. Okay, now step number 3 is to enter our prior year total tax. Again, this is per our actual 2025 tax return. I'm going to say that the amount for this example is $73,282. And where do you get this number on your return? The answer is Form 1040, line 24. And then step number 4, right over here, is to enter our prior year overpayment applied if there was one. This is an overpayment on the 2025 tax return applied to 2026. I'm going to say the amount for purposes of this example is $8,632. And where do we get this number on the tax return? The answer is Form 1040, line 36. But wait, Justin, we haven't filed our tax return yet. We are not actually pulling the trigger on our 2025 return until April the 15th. So how can we enter our 2025 actuals off the return if the 2025 tax return hasn't been filed yet? Well, in that case, you are going to have to use your 2025 estimates for purposes of the Q1 2026 payment calculation. Remember, folks, we can only work with the best information that is available at any given time. It's your responsibility, certainly by April the 11th, 2026, to have your 2025 numbers in good working order. And if you have no idea how to accomplish that, well, that's what the Personal Tax Planning Template Program is for. So if you have not filed your 2025 tax return yet, but you have been in the Personal Tax Planning Template Program and you have your 2025 projection prepared, then we're going to use that projection for purposes of the Q1 estimated tax calculation, because until your tax return is filed on April 15th, that projection will represent the best information that is currently available. The estimate due in cell G15 of the Safe Harbor Method calculator is a negative number, then you are safe. And you will not be dinged with penalties and interest for the underpayment of estimated taxes for Q1 2026. Okay, hopping back over here to the Safe Harbor Estimated Tax Calculator. There is the first number that we entered for 2025. Here is the second number that we entered. And over here is the third number that we entered. And the question was, is the number in cell G15, which is this number right here, is that a negative number? And in this case, the answer is no, that is not a negative number. This says that we have an estimate due of $11,521. However, just for purposes of illustration, let's say that the prior year overpayment applied wasn't $8,632, but instead it was $22,632. Then you can see that the estimate due has become a negative number, meaning that no estimate is actually due for Q1 of 2026. Remember, for those of you who are familiar with the calculator, the amount you actually have to have paid in by Q1 is going to be listed right up here. In this case, it's $23,000. 20,153. So if we have 22,632 already paid in via an overpayment from the prior year, 22,632 is more than the amount required to be paid in, and it's more than that amount by 2,479. So in the case when cell G15 is a negative number, then we are safe. No estimated tax payment is due for Q1. All right, but now what if the amount in cell G15 is a positive number? Let's go back over here and change the prior year overpayment applied back to 8,632. Now we have a positive number again in cell G15. Now coming back over here, in that case, then you need to enter your estimated withholding for 2026 into the safe harbor method calculator. Coming back over here, this is the cell where we will enter our estimated withholding for the current year. Let's assume for the moment that we are expecting withholding of $25,000. Okay, now that we have entered the $25,000, was that sufficient to cause the amount in cell G15 to become a negative number? And in this case, the answer is no. This is still an estimate due of $5,271. Let's run through the calculation one more time. There is $20,153 due for Q1 2026. We have prior year overpayment applied of $8,632. We entered the withholding that we are expecting for the year of $25,000. Withholding by default is treated as occurring on a pro-rata basis, meaning it will be distributed evenly across the 4 quarters just like this. Therefore, only $6,250 of withholding applies to Q1. So we have $20,000 that we have to pay in. We only have $8,600 right here, plus another $6,200 right there. So we are still short by $5,271. In a situation like this, we would have to pay in $5,271 in order to be covered by the safe harbor. Okay, but now wait a minute, Justin. What if I don't know what my estimated withholding is going to be for 2026? Maybe the $25,000 that we just put in was totally a guess. We have no idea if that's even going to be right. Maybe I'm going to have transactions later in the year that will have withholding associated with them, but maybe right now in Q1, I don't even know what the amount of the transaction is going to be. So how am I going to know how much the withholding is going to be? What am I supposed to do if I can't make a reasonable estimate in Q1 what my annual withholding is going to look like? Well, in that case, you have several choices. Option number one is that you can enter your actual withholding from Q1 2026, and then if 25% of that amount causes the number in cell G15 to become negative, then guess what? You are safe. Okay, coming back over here to the safe harbor estimated tax calculator. Now, in the last example, we said that this $25,000 was the estimate of withholding for the entire year. But let's change the assumption. Let's assume now that this withholding was the actual amount of withholding that was incurred in Q1 on all transactions that actually happened in Q1. So this $25,000 is now an actual number for Q1 specifically. Now, with that fact in mind, does that change the way that the IRS will treat withholding by default? And the answer to that is no. Regardless of when withholding occurs, the IRS will treat it by default as occurring pro rata, evenly spread across the 4 quarters. So what did we say in this second sentence right here? If 25% of the amount causes the number in cell G15 to become negative, then we are safe. So did 25% of this $25,000, which is $6,250, did that cause the number in cell G15 to become negative? And the answer is no. But what if we had much larger transactions in Q1? Let's say that our actual withholding for Q1 wasn't $25,000, but instead was $100,000. If our withholding was $100,000, again, this is a Q1 actual, not an estimate for the whole year. If 25% of this actual number, which is $25,000 now, if that amount plus the overpayment from the prior year is enough to cause this number in cell cell G15 to become negative, then we are safe. However, if we revert to the previous example where the Q1 withholding was only $25,000, then 25% of it was not enough to cover the safe harbor, and we are not safe. We owe an estimated tax payment right here. Okay, now hold your horses. What about option number 2 right here? Option 2 says you can enter your actual withholding for Q1 2026, and if condition number 1, 100% of the withholding causes the amount in cell G51 to become a negative number, and condition number 2, you plan to make the election to treat withholding as occurring when it actually occurs, i.e. you will make this election on your 2026 tax return filed in April of 2027. If you satisfy these 2 conditions right here with respect to your actual withholding for Q1, then once again, you are safe for purposes of Q1. Let's go back to the safe harbor estimated tax calculator. So far, there's no change with this number right here. We're saying that our actual withholding for Q1 on all Q1 transactions was a total of $25,000. We're not trying to estimate withholding for the entire year. We're just using this actual. Going back to condition number 1, if 100% of that number causes the amount in G15 to become negative. Okay, coming back over here, how can 100% of this number cause the estimate that is due in cell G15 to become a negative number? Well, the answer would be, instead of going with the IRS default treatment of spreading the withholding out over the 4 quarters, what if we just went into Q1 and put the full $25,000 in there, and then we go into Q2, we make that 0, we make Q3 0, and we make Q4 0. Then $25,000 would be all applied to Q1 right here, and it would cause the amount in cell G15 to become negative, indicating that there is no estimated tax payment due for Q1. So are we allowed to do that? Can we skip over the IRS default method of treating the withholding as occurring pro rata and instead just apply all of this actual Q1 withholding to Q1? And the answer is yes, you can. That is an election that you will have to make on your tax return. Again, we're talking about the tax return for 2026 that will be filed in 2027. So if you make this choice right now here in 2026 and you treat this $25,000 as applying to Q1, that's perfectly fine as long as you remember to make the election when you get to 2027. Because if you do this right here, but then you fail to make the election, guess what happens? You got it. The IRS goes right back to the default position like this, and all that time you thought you were paid inappropriately, guess what the IRS is going to say? No, 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 no. You didn't make the election, and therefore you were underpaid, and therefore you get dinged with underpayment penalties and interest. Also keep in mind that if you elect the withholding to be treated as occurring when it actually occurs, that applies to all 4 quarters. You can't pick and choose by quarter. You can't say, well, the actual withholding for Q1 applies to Q1, but then all the remaining withholding for the rest of the year applies pro rata. No, no, no. It is one or the other per year. So it's either all going to be pro rata or it's all going to apply to the quarter when it actually occurs. All right, now coming back over here to option number 3. Let's say you decide that you are just not confident enough in the amount of withholding that you will ultimately have for 2026, and therefore you are just going to make an estimated tax payment equal to the amount in cell G15. If you do that, then you are safe. Let's come back over here one more time and assume again that this is a full year projection. We're estimating $25,000 for the whole year, but let's just say that we're not really confident in that number. I'm just not sure based on all the unknowns and uncertainty regarding transactions that might be occurring later in the year. I think this might be a little bit aggressive. Maybe really it's only going to be like $15,000. And so what I'm going to do is enter the most conservative amount that I can, which is still realistic, but it's not on the aggressive end of my estimates. I'm going to say I feel pretty confident that I'll have at least 15,000, but I'm not sure about 25,000. So I'm going to do the conservative thing. I'm going to put 15,000 right here. I'm not planning to elect to have withholding occur when it actually occurs. I'm going to go with the default. Therefore, the withholding will be applied across the 4 quarters just like this. I do have the overpayment from 2025, so the grand total of that plus the withholding is 12,382. I'm still short, however, of 7,771 compared to the amount that I have to be paid in. And so what am I going to do in this cell right here? I'm going to make an estimated tax payment of 7,771, and by doing that, I will be safe. The amount that I needed to pay in under the safe harbor has been paid in. If I'm still feeling a little bit uncomfortable about this withholding number, I could make the amount lower, or I could just bump up the payment a little bit. If I really am uncertain, I could say, well, let's just make it $8,300. That gives me about $500 of cushion that could apply to Q1 if I need it, but if it doesn't apply to Q1, if I don't need it, it will just end up carrying over to Q2 and applying over there. Okay, but now hold on just a second. What if you want to use the 90% of current year safe harbor method? Going back over here, I'm not sure that everybody picked up on this yet. Certainly those folks inside of the personal tax planning template program should have. But if you're new to the channel, if you're new to the program, what I want you to notice right here is that the safe harbor is based on the minimum of 2 numbers. The first number is 100% or 110% of the prior year's tax. In this case, the prior year's tax is $73,282. The decision as to whether it is based on 100% or 110% of the prior year depends on the amount of AGI that you had in the prior year. If this number right here is less than $150,000, then the safe harbor calculated down here will be 100% of the prior year's tax. In other words, the number right here will be equal to this number right there. However, because the amount of AGI is greater than $150,000, the safe harbor is calculated based on 110% of the prior year's number, leading to $80,610. The other possible safe harbor is 90% of the current year's tax. That amount is calculated based off of 90% of the number that we entered here, which we have not covered this number yet in this video. This says enter the current year's total tax, the projected amount for 2026. Where does this number of 99,199, where does this come from? I can hear all the smarties out there saying it right now. It comes from the personal tax planning template, specifically the 2026 projection column. If we scroll all the way down to the bottom of the 2026 projection column to the projected tax line, there it is right there. Total tax projected for 2026, 99,199. That is where this estimated tax number for 2026 comes from. The safe harbor is calculated as 90% of that number, and then the final safe harbor is going to be the minimum of these 2 amounts right here. In this case, it's the $80,610, which means the safe harbor is based on the prior year. Okay, now coming back to the original question, which was, well, what about using the 90% of current year tax safe harbor? The answer is you would not do that if the 90% of current year is going to be more than 100% or 110% of last year. And typically you can see pretty quickly that if you're expecting an increase in tax in the current year over the prior year, which we often are in this class, because what many people in the program are trying to accomplish is Roth IRA conversions, or they're trying to do capital gain harvesting. All of these tax planning strategies may increase your tax in the current year versus the prior year. And so if that's the case, it's very unlikely that you're going to be using the 90% of current year safe harbor. It's generally only if your current year total tax projection is going down relative to the prior year that you would consider using the 90% method. So what if we have that situation? Let's go back to the personal tax planning template. Okay, here we are. I have reduced the amount of income that this individual or couple is projecting for 2026, and in turn that has reduced the amount of tax being projected to $42,000. 42,799. So now if we go back to the safe harbor method calculator and we change this to 42,799, you can see, okay, wait a minute, now the 90% of the current year projection is significantly lower than the 110% of prior year, and therefore it would be highly desirable to make our estimated payments based on this number instead. Going back over here to Q1, I can already see that 8,632 of overpayment applied, plus 3,750 of the withholding, in other words, 25% of the annual withholding. Combined, those two are already more than the amount that is required to be paid in under the safe harbor. Therefore, we don't need to make this payment after all. I'm going to put that back to zero. Using the 90% method in a case where the projection of income and tax for 2026 is going down, if that causes the number in cell G15 to become negative, then we are safe. Okay, but what about the annualized income installment method? Should I make my estimates based on the plan to elect that method when I file my 2026 return in 2027? Well, let's do a few pop quiz questions to make sure that everyone understands the annualized income installment method and when we need to think about it. So question number 1, does the annualized income installment method matter at all if you're using the safe harbor calculations based on the prior year? And the answer to that is no. If your safe harbor payments are based on 2025, in other words, the prior year, then you are safe regardless of what your 2026 income turns out to be. Remember, the annualized income installment method is based on your income in the current year, when your income is actually occurring in 2026. But if your estimates are based on the prior year's safe harbor, then it does not matter at all what your income is for 2026. It does not matter at all when your income is generated in 2026, whether it's pro rata or it's generated unevenly throughout the year. None of that matters. Nothing about current year income matters if you are basing your safe harbor on the prior year numbers, and therefore if nothing about the current year income matters, then the annualized income installment method does not need to be considered in cases where we're using the prior year safe harbor. Okay, now question number 2, under what fact pattern would I consider possibly basing my estimated taxes on the annualized income installment method? Well, there are 3 basic conditions that you would have to meet to make the annualized income installment method worth considering. Condition number 1 is that you have to be basing your safe harbor payments on 90% of the current year's estimate in the first place. As we just went through extensively above, if you're basing them on the prior year, then the annualized income installment method would not even be relevant. Condition number 2 is that you expect significantly more income to be generated in Q3 or Q4 of the current year, in this case 2026. Again, that generally comes from doing Roth conversions or capital gain harvesting, or it could come from seasonal income, if that seasonal income happens to be concentrated in the latter part of the year. And then condition number 3 is that the time value of money effect, or time value of money benefit to you, of paying your estimated tax payments in a pattern that is similar to the following. For example, it would be something like this. Q1, you pay a lower amount, like 10%. Q2, you pay 10%. Q3, you pay 10%. And then finally in Q4, you pay 70% of the estimated taxes that are due for the year. So paying in a pattern that looks something like this is more beneficial to you from a time value of money perspective versus paying in a pattern that looks like this, like the default, where 25% of what you owe for the year is spread out evenly across the quarters. And the question ultimately becomes, is the time value of money benefit of doing this right here in the first row as compared to this down here in the second row, is that worth more to you than the effort to determine the amount of appropriate payments under the annualized income installment method? In other words, you could pay just like this with 90% of the current year's amount using the safe harbor method, or you could take a little bit more time and effort to calculate the payments based on this right here. Is the time value of money effect of doing that worth more to you than the effort to complete it? And the answer, of course, is going to be based on your facts and circumstances, but let's try to put some numbers around behind it. Let's say that you can create a delayed payment of the following amounts: $20,000 in Q1, $20,000 in Q2, $20,000 in Q3. This entire $60,000 would be delayed and ultimately paid in the fourth quarter. But then let's say you can throw that money into a muni bond fund and you can get a tax-free interest rate of return of, let's just say, 5% on that money. So on an annual basis, the interest earned for each one of these tranches would be $1,000. If we divide that number by 12 to put this on a monthly basis, it would be income of $83 a month. The number of months deferred using the annualized income installment method would be 9 months for the first tranche, 6 months for the second tranche, and 3 months for the third tranche. So in this fact pattern right here, the time value of money effect of doing that, as opposed to paying under the safe harbor method, would be tax-free muni bond income of $750 for the first tranche, $500 for the second, plus $250 for the third, with a grand total of about $1,500 in this example. So is that worth it to you? I don't know. Only you can answer that question. Only you can decide if the time value of money benefit of figuring out how to defer these payments right here into the final quarter, if that is worth the few hours of time that it will take you to figure that out. Alternatively, in the same number of hours, I do feel confident that you would have sufficient time to put back at least 1, 2, 3, 4 margaritas, maybe even more. There's nothing wrong with doing that. That is a personal choice how you want to spend your time, and if the time value of money benefit of enjoying 4 to 6 margaritas on a sunny afternoon with your better half is more valuable than investing that time in figuring out how to pay less using the annualized income installment method for making estimated tax payments, then that is a perfectly legitimate choice. By the way, the safe harbor method calculator that you have seen me demonstrating throughout this video, as well as the annualized income installment method calculator, are both included with your purchase of the personal tax planning template program. Both of these calculators come with complete video instruction on how to use them, how to fill them out, and how to determine if you are safe under either of these two methods. Your purchase of my personal tax planning template and video training program gives you lifetime access to what is, without a doubt, the most comprehensive and accessible individual income tax training program on the market in the United States today. I love that I can see where every number comes from is one of the most common compliments that I hear about the personal tax planning template. Gone are the days of the other guy's black box, quote unquote, tax planning software that number one spits out some results that you don't understand based on number two calculations that you cannot see. In the personal tax planning template, you can see every number and every calculation. Plus, you will get all new 2026 line-by-line video training content that will be released regularly throughout the remainder of 2026, and that is in addition to all of the 2025 training content, which is accessible to you at any time. Take a look at some of these recent comments from members of the personal tax planning template program. Good morning, Justin. It is so helpful and stress reducing to have a good idea of my current and future tax positions using the personal tax planning template. I have learned a lot from watching your videos and using your personal tax planning template spreadsheet. Thank you for all that you do. And then right over here, hi Justin. First of all, thanks for all that you do to help those of us who prepare our own tax returns and do our own tax planning by providing this amazing spreadsheet. And then down here, Justin, your spreadsheet is amazing, as is all the work that you have put into it and the videos. It's like having a financial advisor report whenever I want for whatever changes happen or that I need to model. And then right over here, your videos are so detailed and understandable. Thank you for helping us primarily old school retirees. As I said, you can find a link to join the personal tax planning template program in the description below this video on YouTube. Joining the program does get you instant access to the safe harbor method calculator as well as the annualized income installment method calculator. And that's going to be it for today. Thanks everybody for watching, and I'll see you next time.